Markets are currently closed, with the last trading session for Supermicro Computer Inc., ticker symbol SMCI, concluding with the stock priced exactly at $33.15. This represents a significant intraday surge, moving up nearly 11.6% in the final session alone, capping off a week of extreme volatility that saw the equity bounce from the absolute brink of disaster. If you are looking at your brokerage account right now, whether it's on a Fidelity mobile app or through the Interactive Brokers trading dashboard, you are looking at a chart that looks less like a corporate equity and more like a defibrillator readout. The expectation for this stock was, quite frankly, a funeral. The prevailing narrative on Wall Street, echoed in every institutional research note and retail forum, was that Supermicro was the next Enron, a company destined for delisting, drowning in accounting irregularities, and abandoned by its auditor. That was the expectation, a zero. The reality, however, has violently diverged from that grim prediction. What we are witnessing is not a death spiral, but a Lazarus trade of epic proportions. The reality is that the company has secured a new auditor, BDO USA, just hours before the Nasdaq guillotine was set to drop, effectively buying them a lifeline that the market had priced as impossible. This disconnect between the expectation of immediate bankruptcy and the reality of a structural turnaround has created one of the most aggressive short squeeze setups we have seen in the semiconductor space since the early days of the Tesla stock recovery. You are not just watching a stock move, you are watching a repricing of survival probability. The massive green candle you see on the daily chart is the sound of thousands of short sellers rushing for the exit, realizing that their thesis of immediate delisting has been shattered. We need to discuss the mechanics of this move because it is critical to understanding where we go from here. When Ernst & Young resigned in October, they didn't just leave, they scorched the earth, stating they could no longer rely on management's representations. In the world of online investing, that is usually a death knell. Funds managed by Fidelity Wealth Management or massive passive vehicles held in Schwab Intelligent Portfolios are typically mandated to liquidate positions in companies with such severe governance red flags. That selling pressure crushed the stock from its highs of $120 down to the teens. But the reversal we are seeing now is the result of event-driven capital flooding back in. The appointment of BDO isn't just an administrative update. It is a signal that a top-tier accounting firm has looked at the books and decided the risk is manageable. This validates the bullish thesis that the accounting issues, while serious, might be retrospective rather than an ongoing fraud. Let's look at the volume. The trading volume on Friday alone was colossal, eclipsing the average daily volume by a significant margin. This indicates institutional participation. Retail traders on the Robinhood app or those engaging in SoFi active investing are certainly present, chasing the momentum, but the sheer size of the block orders suggests that hedge funds are stepping in to front-run the potential filing of the delayed 10K. When you see this kind of volume accompanied by a double-digit percentage gain, it signifies a change of character in the stock. The downward trend, characterized by lower highs and lower lows, has been technically broken on the short-term frame time. The stock has reclaimed the $30 level, a psychological fortress that bulls needed to hold to prove that the recovery wasn't just a dead cat bounce. However, we must be extremely nuanced here. While the Nvidia stock narrative is about unbridled growth and dominance, the SMCI narrative is about distressed value. Investors using Interactive Brokers stock trading tools to analyze the order flow are seeing a war zone. On one side, you have the deep value investors who realize that SMCI is still trading at a single-digit price-to-earnings ratio, absurdly cheap for a company central to the AI boom. On the other hand, you have the forensic accountants and skeptics who believe the DOJ probe is the shoe that hasn't dropped yet. This tension creates the volatility. A normal stock moves 1% or 2% a day. SMCI is moving 10 to 15% regularly. This is not a stock for a conservative Schwab Intelligent Portfolio allocation. This is a gladiator arena. Speaking of that arena, comment below how many shares of SMCI you currently hold, and more importantly, at what price average. Are you underwater from the 80s, or did you catch the falling knife in the low 20s? I want to know the psychology of the room. Now, let's pull back and discuss what this company actually does. Because amidst the accounting drama, people forget that Supermicro is the plumbing of the AI economy. If NVIDIA stock is the gold, Supermicro sells the high-tech picks and shovels. They manufacture high-performance server solutions. But they aren't just bending metal. They are the leaders in direct liquid cooling. This is the critical differentiator. The new Blackwell chips from NVIDIA are exceptionally power-hungry and run incredibly hot. Traditional air cooling, fans blowing over heat sinks, simply cannot handle the thermal density of these new AI clusters efficiently. You need liquid cooling. Supermicro has been preparing for this transition for years, while competitors like Dell and HPE Enterprise are playing catch-up. The business model is built on building block solutions. Unlike competitors who sell rigid, pre-configured boxes, Supermicro allows hyperscalers, the Amazons, Metas, and Microsofts of the world, to customize their server racks down to the granular level. This speed to market is their moat. When NVIDIA releases a new chip, Supermicro is typically the first to have a server rack ready to deploy it. This first-mover advantage is why their revenue grew at a triple-digit pace earlier this year. However, the reality part of our equation strikes again here. Their gross margins have been compressing. In the most recent data, margins slipped below 10%. This is a concern. It suggests that to keep market share, they are engaging in a price war with Dell. If you are analyzing this for your individual brokerage account, you have to ask, is the profitless revenue growth worth the risk? The relationship with NVIDIA is paramount. Jensen Huang, the CEO of NVIDIA, has publicly endorsed Supermicro multiple times. However, reports circulated recently that NVIDIA was diverting orders from Supermicro to other vendors due to the accounting chaos. This was the nuclear winter scenario for the stock. But if the BDO audit proceeds cleanly and the 10K is filed, those orders likely return or stabilize. The market is forward-looking. It is currently pricing in a scenario where Supermicro remains a key, albeit slightly tarnished, partner in the AI supply chain. Let's talk about the retail versus institutional dynamic again. On platforms like SoFi Invest and Robinhood Crypto Circles, SMCI has become a meme-adjacent stock. It attracts the same liquidity that chases high beta volatility, but the smart money, the flows we track through Fidelity Investments' dark pools, are positioning for the compliance plan. Supermicro has submitted a plan to Nasdaq outlining how they will regain compliance. Nasdaq's acceptance of this plan is the next binary catalyst. If Nasdaq accepts the plan, the stock has a clear runway until February 2025 to file their documents. That removes the immediate delisting overhang. If Nasdaq rejects it, the stock goes to the pink sheets, and the liquidity dries up instantly because many Fidelity mutual funds and Fidelity ETFs can't hold OTC stocks. This brings us to the online investment landscape. For those of you engaged in self-investing, you know that information asymmetry is your enemy. In the case of SMCI, the asymmetry lies in the internal controls. The previous auditor explicitly questioned the tone at the top. This is corporate speak for, "We don't trust the CEO." For a long-term investor, perhaps someone managing a Fidelity IRA's account, this is a massive red flag. Governance issues are rarely one-off events. They are often cultural. However, for a trader, this is irrelevant as long as the stock stays listed. The trade is purely about the resolution of uncertainty, not the perfection of governance. We must also consider the broader sector. Apple stock is pushing into on-device AI, and Tesla stock is building massive Dojo supercomputers. All of this requires infrastructure. The total addressable market for AI servers is expanding, not contracting. Even if Supermicro loses some market share to Dell or HPE Enterprise, the pie is growing so fast that they can still grow revenue. The question is profitability. Can they fix their internal accounting and manage a complex manufacturing supply chain simultaneously? The logistical challenge of ramping up liquid-cooled racks while under a DOJ microscope is immense. Let's look closer at the recent price action on the chart. We established a double bottom structure around the $17 to $18 mark. In technical analysis, this is often a powerful reversal signal. It indicates that sellers have exhausted their inventory. The stock then reclaimed the 20-day moving average. The next major level of resistance is the gap fill around $38 to $40, and then the massive psychological level of $50. If the stock can break $50 with volume, it creates a blue sky breakout on the lower